You've no doubt heard recession speculation for a while now, and the talk has been going on for so long that it's reasonable that some people, maybe even you, don't think it'll happen at all. Today, I'm going to address this with a discussion of a simple indicator that is critical to understanding what's happening with the economy. And I'm also going to point out how I think you are being misled. The topic is the yield curve, and it's a wonky, technical thing, but it doesn't have to be. And I'm going to simplify it for you and explain why it's one of the most important economic leading indicators. This is not investment advice, and you should not use this snippet in isolation to make investment decisions. In general, since no one can predict the future, people should strive to have a diversified portfolio that can endure various economic environments. I'm an investment advisor, and if you're interested in working together, please reach out to me. When investing, we must look through the windshield, not through the rearview mirror. When you hear someone say, employment is doing X, and so that means the Federal Reserve will do Y, or hey, look at the most recent inflation readings, you have to ask yourself, is inflation a leading indicator? Am I looking through the windshield to see where I'm going when I consider the latest inflation number, or am I looking through the rearview mirror? The answer is that inflation is not a leading indicator. Employment is not a leading indicator. Think about your own experience. It's difficult and time-consuming for businesses to hire people. When a business slows down, not in advance of a slowdown, when activity for a business slows down, most businesses try to hold on to their employees and not fire people in the hopes that it's only a short slowdown. But when things are bad enough for long enough, we start to see layoffs as companies can't hold on anymore. But that's not typically predictive. The economy is already bad by that time. Let's look through the windshield. The Conference Board publishes a leading economic index, LEI. And you can see how well this index is done in predicting recessions. The blue line is the year-over-year change in this indicator, and the gray areas are recessions. If you followed economic data for decades in real time, like I have, most of the time the data is mixed. It's a mixed bag. Some good elements, some bad elements, and usually a decent amount of ambiguity. But now the leading economic index is unambiguous. It is unambiguously predicting a recession. Here's a list of the components that comprise the LEI. In my opinion, the most important standalone element of the leading economic index is the yield curve. Here's a graph of the yield curve. The grayed areas are recessions, and when the blue line is below zero, that's when the yield curve is inverted. This has profound implications for the banking system, and there is a fundamental reason why this relationship exists. Let's take a step back. If I were going to lend you money for 1 day, 1 year, or 10 years, the interest rate we would agree to in each of those scenarios would probably be different. After all, if I lend you money for 1 day, there isn't a whole lot you can do with it during that time. So you would probably not be willing to pay that much interest to borrow money for 1 day. Also, I, as the lender, could be confident that my opportunity set tomorrow will probably look a lot like today, so I would probably only demand a low interest rate. However, if I lend you money for 10 years, that interest rate would typically be higher because you would have time to do something productive with the money, and also I would probably require a higher rate of interest to lend money out for so long because I would have to forego all the opportunities that would arise in the next 10 years. And these are just a couple of the important considerations. So the yield curve is really just a graph that compares the interest rates that corresponds to loans made for different periods of time. And in my little example, we were two individuals, but we could make a yield curve for any entity that borrows. And the yield curve most relevant to our conversation today is the government yield curve, the price that the government must pay to borrow money for different periods of time. What I just described to you are a few of the elements that make the yield curve normal, which means that it's upward sloping. If you look at your screen, you'll see that the top line of the graph shows a normal yield curve, which means that longer-term rates are higher than shorter-term rates. The yield curve spends the vast majority of its time in some version of normal. Why is this important? Our whole banking system pays for funds at a short-term rate, and then they're making longer-term loans and earning a higher rate. If their cost to borrow is, let's say, 3%, and their longer-term loans are yielding, let's say, 5%, then the bank makes 2%. This creates an incentive for the bank, and not just a bank, but the whole banking system in aggregate to expand. There is a profit incentive for the banks to borrow more and lend more, and even increase the amount of leverage in the banking system. When the yield curve is normal, there's an economic incentive for the banking system to expand because, hey, look at the fat spreads the banks are making. This is a tailwind to economic activity, and these new loans from the banking system actually create new dollars. However, there are times, like now, when the yield curve is not normal, it's inverted. An inverted yield curve means that short-term rates are higher than long-term rates. And here we get to the most important part. This is the point that I want to stress. When the yield curve is inverted, the banks no longer have an incentive to grow. In fact, they probably have an incentive to shrink. Look at the bottom line of this graph again. The short rate is higher than the long rate. The cost of funds to the bank is more than the bank can earn on the funds. And as the banks reduce the size of their aggregate commitments, that translates some number of months later into an economic slowdown. Okay, that sounds like common sense, but it's not. This is a very complex topic, and I'm distilling the most fundamental dynamic of why the yield curve is important as an economic indicator. Whenever you have a complex topic with lots of political and economic interest, you can rest assured you are unlikely to be told the truth, or at least you can be told many things that are true, but also misleading. One important lesson from economic history is that when the yield curve is inverted, there will be no shortage of credible, prominent economists vocally proclaiming that this time is different. The inverted yield curve doesn't mean what it's meant before. Let's start with the Federal Reserve. We can trust them to tell us the truth, right? Well, the Federal Reserve is supposed to be independent, but they're appointed by the president, they're confirmed by Congress, and even though the Fed board members can't be fired, or at least it hasn't been tried, in a sense, the Federal Reserve does report to Congress, and Congress can change the rules if it wants to. Former Fed Chair Alan Greenspan, now retired, has even admitted as much, that the Fed is independent, but there is a limit, and it's conceivable that independence can go away. Therefore, if the yield curve says we're going into a recession, the Federal Reserve has an incentive to publicly provide a different explanation, because otherwise a bunch of politicians are going to be mad at him. I'm not calling anyone a liar, I'm just pointing out an incentive. For example, here is a recent exchange between Elizabeth Warren and Chair Powell, where she is complaining that his inflation fighting is going to put millions of people out of work. Quote, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their job? End quote. So you can see that if Federal Reserve policy is the major driver of the shape of the yield curve, which I think it is, and which at times can be highly predictive of recessions, the Federal Reserve has an incentive to keep their heads down and not wave a flag about it, because they'll be publicly beaten up by a bunch of politicians. This sleight of hand that's done is that when these financial officials are brushing off the strength of the yield curve as an economic indicator of business cycles, they focus on the reasons why they think the yield curve is inverted rather than the effect the inversion has with regards to the banking system shrinking, or at least not growing as fast. Remember, my take is I don't really care why the yield curve is inverted, only that it is, because that creates an incentive for the banks to shrink. For example, here is current Federal Reserve Board member Christopher Waller. Waller says, quote, "What you're seeing in the inversion is not so much fears about bad economic outcomes in the future, but belief and trust that we are going to bring inflation back down and rates will be lower in the future once we do that," end quote. He might be right about that latter point. That's what makes this so difficult for you to get a real explanation of what's going on. Since this is a very complicated topic, officials can say many things that are true, but also misleading. Waller wants you to focus on why the yield curve is inverted, that investors have, quote, "belief and trust that the Fed will bring inflation back down." I think that's a reasonable statement. But he doesn't want you to consider the effect of the inversion. He wants you to look at this and say, yeah, don't worry about it. Let's go to former Fed chair and now Nobel laureate Ben Bernanke. Bernanke addresses the yield curve in this 2005 speech. Again, you will see that his focus is on the reason for the inversion rather than the effect of the inversion. This paper is titled "The Global Savings Glut and the U.S. Current Account Deficit." Bernanke says, quote, "I will argue that over the past decade, a combination of diverse forces has created a significant increase in the global supply of savings, a global savings glut, which helped to explain both the increase in the U.S. current account deficit and the relatively low level of long-term interest rates in the world today," end quote. Bernanke introduces this idea of a global savings glut, a GSG. Basically says that, hey, some people are alarmed about the inverted yield curve, but just because some central banks in Asia have lots of US dollar savings and are willing to lend the US government money at really low rates, and that in turn will have a tendency to lower mortgage rates for borrowers here in the US, then what's wrong with that? That's great for us, right? Again, you will see that Bernanke is focused on the reason for the inversion. The global savings glut drives demand for long-term government bonds. He doesn't comment on how the inverted curve chills the loan growth incentives of the US banking system. And at the risk of beating a dead horse, here are some other remarks by Nobel laureate Bernanke just before the global financial crisis, telling you why you shouldn't worry about the inverted yield curve. He made these remarks in 2006 when the curve was inverted or very close to being inverted. You can read what I've highlighted on the screen. I don't want to put you to sleep. In plain English, he's saying that maybe the reason the curve is inverted is that investors think the economy will go bust, the Federal Reserve will have to cut short-term rates aggressively, and the high short-term rates are temporary. And he also concedes that, sure, historically, the yield curve has flattened or inverted in advance of recessions. But then he goes on to say why that's not the case this time. As he says, quote, "I would not interpret the currently very flat yield curve as indicating a significant economic slowdown to come for several reasons," end quote. Don't forget, we now know that in hindsight, he was wrong about his conclusion. So what were his reasons? His first point is that, remember, the yield curve shows a relationship between different interest rates, not the absolute level. Bernanke says that absolute rates were high before and now they're low. He doesn't say why he thinks this matters, and I've never heard a compelling theory as to why the absolute level of rates would matter with regards to an inversion, nor have I ever discovered a meaningful relationship in my own research. What we've seen over the past 40 years is that a yield curve inversion is a powerful indicator regardless of whether that inversion happened when rates were high or if it happened when rates were low. And indeed, the fact that we went on to have a recession is further evidence that the absolute level of rates of interest do not negate the power of the yield curve as a recession predictor. He goes on to say that, quote, second, as I've already discussed, to the extent that the flattening or inversion of the yield curve is the result of a smaller term premium, the implications for future economic activity are positive rather than negative, end quote. Wade through this wonky economist speak here about term premium. When he says the term premium is smaller, what he's saying is that investors are willing to lend the government money at such a low interest rate because they're confident the Fed will do an excellent job managing the economy. And from Bernanke's perspective, not only is that not bad, that's good. He wants the market to have confidence the Fed will do the job. But again, he's telling you why the curve is inverted, rather than any discussion about the implications of the inverted yield curve and its effect on the incentives of the banking system to make loans. And finally, he says, and I'll paraphrase, hey, the yield curve is only one indicator. We've got a zillion indicators that we think are meaningful, and a lot of them are reading consistent with solid economic growth. This statement, in conjunction with the recession that we know followed, only strengthens the case for why this indicator is so important and informative. Bernanke says the yield curve says something bad is coming, but these other great leading indicators say that we won't have a recession. But then we did have a recession. So we know that the yield curve was highly predictive at the time, and the other indicators that he referenced were not. I focused on the Federal Reserve because at least they're supposed to be independent. The Treasury Secretary is not independent and can be fired at any time. The Treasury Secretary works for the President, so Janet Yellen isn't going to tell you when we're going into recession because that's politically bad for her boss, Joe Biden, and I'm not signaling her out. The same is true about every previous Treasury Secretary. How about Wall Street? Well, Wall Street employs lots of economists, but Wall Street is generally in the business of selling you stocks, so they will rarely predict a recession. Let's go back to my original point. The inverted yield curve creates an economic incentive for the banking system to shrink. And so what does that mean? It means they make fewer loans. And that's happening. Here's data from the St. Louis Fed that shows that bank credit is contracting. Big deal, you say. It's not really dropping that sharply, it's just going sideways a bit. Here's a longer-term perspective. The last time we saw a notable decline was in 2008. This is deflationary. There's a dirty little secret that our economy requires a continuous expansion of credit to work well. And when the yield curve is inverted, the incentive to expand credit isn't there. In addition to the effect the yield curve has on bank credit, don't forget we've already had the second, third, and fourth largest bank failures in history, so I'm sure this is also having a chilling effect on loan growth, which is an additional but related headwind. This is not an asset allocation video. I'm talking about the US economy, but the question is, what does this mean for US stocks, growth stocks, value stocks, non-US developed stock markets, the banking system, the energy complex, emerging markets, bonds, precious metals, and commodities? That's a whole different conversation. The last thing I'll say is that I think there is an important dynamic which may be counteracting a recession and could be the reason it hasn't come as quickly as predicted, and that is the fiscal deficit. That's going to be my next video, but the teaser is that interest rates have gone up at a time when government debt is larger than at any time in post-war history. Government interest payments have risen sharply, making our fiscal deficit even larger. So that's like a stimulus program. I'll cover that in the future, but I don't think it'll be enough to counteract the contraction in the banking system. Don't forget, we live in a probabilistic world. There's almost nothing we know with certainty. We've got to look at the data and do our best to fundamentally understand the system to make the best assessment of the future. Thanks for listening. Please like and subscribe for future comments.